My name is Argia Sbordone, and I will be talking about the second piece of the morning. So the roadmap of my talk, and I will try to connect my talk here with this picture to the other presentation. So roadmap, in this bottom here is the goals, the things that you just heard. What I'm going to talk about are the operating targets that the Fed sets in order to reach the goals. So I'm going to tell you what operating targets are. Then I'm going to talk about the tools through which the Fed reaches the operating target that help reaching the final goals. Then I'm talking about a little bit here of the governance of the Federal Reserve System, who makes the decision about the tools and about the operating target. And after me, Chris will talk about how these tools gets implemented in order to reach the operating target. And after Chris, John McCarthy will talk how the operating target transmit their effect to the goals, so succeed or not to reach the goals. And this is what we call the transmission mechanism. Okay, then in addition, I will talk about the framework of the decision that the FOMC makes. So what's the framework? What is the strategy that the FOMC uses to make monetary policy? I'll talk about the current policy strategy. As you already have heard, there will be many things during these presentations that will overlap. It's just to make things more clear, and everything is obviously connected. So I'll talk about the forward guidance and the threshold, and how we do programs of outcome-based asset purchases. And then I'll talk about the challenges ahead. And then forward guidance is something that you will hear even more in the maybe late in the morning by Krishna. He will talk about communication. Okay, so meeting the objectives. Objectives or goals, I use this word interchangeably. Monetary policy doesn't directly affect the economy, but it affects the economy through the flow of credit that gets into the economy. So the flow of credit influences financial condition affects spending, and this allows to lower unemployment, promote employment, and maintain price stability. The flow of credit is regulated through easing or tightening. So if the Fed wants to stimulate the economy, it has to ease credit, so make the flow of credit larger into the economy. If it wants to tighten, then it has to reduce the flow of credit, and this reduces the stimulus to the economy. So the Fed explained the stance of policy, means how much credit wants to flow in the economy at any point in time, by setting what I named the level of the operating target. So what are the operating targets? The operating targets are intermediate targets that the Fed sets, some guideposts that the central bank wants to achieve in order to achieve then the final goals. Now, in order to be good operating targets, a variable has to be under the control of the Fed, and relatively well under the control of the Fed, and it has to be effective in transmitting the stimulus in reaching the goals. So those are two characteristics. Currently, the Fed uses two sorts of operating target. One is the traditional one, the federal funds rate target. And that's the traditional tools that is continue to be used, but currently is a little impaired. And then a second operating target that has been introduced since the crisis, since at some point in the crisis, is the managing of the asset holding or balance sheet policy that the Fed sometimes that is expressed in terms of LSAP, or large scale asset purchases. Some people refer to them as quantitative easing. Is that we more broadly we say balance sheet policies or Fed's asset holding. Okay, let me talk a little bit about the federal funds rate. The federal funds rate is the rate at which banks borrow and lend funds, reserve funds, among themselves. And this market is a market in which it's an overnight market, federal funds market, and reserves are the funds that the banks hold at the Federal Reserve, and the loans on the federal fund market do not require collateral. Why the federal funds rate is a good operating target? Well, because it's pretty much under the control of the Fed through the market for reserves, the intervention in the market for reserves that you will hear a lot about from Chris after my presentation. He will tell you what has changed in the managing of the intervention on the federal funds market. And is control, in addition of being relatively well under the control of the Fed, it transmits the effect to all the structure of the interest rate. And I have a picture here that shows how this rate moved together. So the red line is the federal funds rate, the green line is the 3-month Treasury rate, and the blue line is the 10-year Treasury. So what you see is that these rates have been declining since 1984. 1984 is the beginning of the conquer of inflation, so also the rates that were pretty high start to declining, and you see that the long-term rate follow pretty much the short-term rates as a tendency, and the three months Treasury is very close to the federal funds rate. Now, in the traditional operation of the federal funds market, so before in particular one instrument, one tool has been introduced, which is the interest on reserves, IOR. The Federal Reserve, the federal funds market was working in the following sense. The Federal Reserve sets a target for the federal funds market and then intervenes on the federal funds market by offering or withdrawing reserves to meet the demand. The equilibrium between the demand and the supply of reserves determines this equilibrium interest rate. Now, this market for reserves works a little differently now, but I delayed this, I deferred this to the next implementation presentation to give more a clear sense of what is different today from before the introduction of the interest on reserves. Now, the tools by which the Fed change the amount of reserves in the economy are some traditional one, the reserve requirement ratio. Again, I'll go fast because you'll hear this better next presentation. The reserve requirement ratio is the percentage of deposit the commercial bank needs to have at the Fed. The discount window or primary credit facility is the resource, the window at which the Fed directly lends to commercial banks. And there has been a lot of lending going on during the first part of the crisis, not only to commercial banks, but to a number of intermediaries. And this facility reflects the role of the Fed as lender of last resort. So when there is not enough liquidity, the Fed uses this facility. The interest on reserves, as I mentioned, is a new features that has been introduced since December 2008 that allows the Fed to pay interest on the reserves that are currently held at the Federal Reserve Bank. Most important tool is the open market operation. This is the tool through which the Fed, actually the New York Fed desk implements the purchase of and sale of Treasury securities on the secondary market. And now, if the Fed purchases Treasury securities, then he injects liquidity in the economy, and vice versa if it sells. Now, this is something that people were not very familiar with before the crisis. Now, everybody is more familiar with the balance sheet of the Fed. The balance sheet of the Fed is something like that. This is a very stylized version of the balance sheet through which I want you to show what's the effect of open market operation on the balance sheet of the Fed. So the balance sheet has two parts, the assets and liability. The bulk of the asset is the Treasury securities. So you don't see the bottom line. This is a stylized version of a balance sheet of the Fed in 2007. I think it's like July or something, 2007. So before the crisis. The total the assets were composed essentially by Treasury securities, and the total assets were below $1 trillion. This is 867 billion. The liabilities were composed essentially by currency, and then there were some reserve balances for the total of 867. Now, what's the effect of an open market operation on this balance? Well, the effect is, suppose the Fed buys 10 billion of treasury securities, then there will be an addition on the asset side, and at the same time, this purchase creates reserves in the system, and so you have that as a total, you have an increase in the balance sheet for the amount of the purchases. Now, not all the operation not all the change in reserve change the balance sheet, because you may have a change of reserves into currency, and in that case, the total amount of liability doesn't change, the total amount of asset doesn't change, so the balance sheet is unaffected. Monetary policy since the crisis has evolved tremendously, and this has generated an enormous change in the balance sheet. So what are the changes of monetary policy? And then I'll tell you why there were those changes. When there is a recession, or when there is the risk that you're running into a recession, the Federal Reserve has to prevent as much as possible the contraction of credit. And so what it does, according to what I tried to explain, lowers the interest rate. And so that's how the Fed proceeded in this instance, to start lowering the federal funds rate. We entered the recession with the federal funds rate at 5.25%, and then with the successive moves, this rate was lowered from August 2007 till December 2008, progressively to reach a level that is no more just a single rate, but is an interval from 0 to 25 basis points. This is what we called the zero lower bound, or ZLB. So the federal funds rate has reached the floor. And now there is a large amount of reserves that keeps this rate at the floor. Now, under this constraint, the Fed has to be very creative and decide what tools it can have to continue to stimulate the economy, even if the traditional tools of lowering the interest rate was no more available. So it starts at what we are called unconventional or non-traditional, or some other terms, non-traditional policy. And these non-traditional policies are the following. As I mentioned before, it increased the number of operating targets, so not just the federal funds rate, but asset holding that becomes an operating target, or better say, the balance sheet policies introduced as an additional operating target. But also, in terms of the federal funds rate, the Fed started to use what is called the forward guidance. So forward guidance means telling in its communication to the financial market that the interest rate that is at 0 will continue to be at 0 for a longer period of time. And why this is important? Well, because the purpose of the Fed is to lower the long-term rates. Remember the graph that I show you. So if you want to keep the lower long-term interest rate, which are the one important for the interest-sensitive spending, for mortgages, for buying durables, and so on, then the expectation of the short-term rates is a great component of the long-term rate, in addition to the term premium. So by providing forward guidance on the short-term rates, the Fed provides information on how long it would be in an accommodative stance for policy. And this is supposed to provide stimulus to the economy. So let me, before talking a little more about forward guidance, let me talk about this balance sheet policy and their effect. So the Fed implemented a number of large-scale asset purchases programs. The first one was implemented in November 2008, and was the purchase of agency mortgage-backed securities and agency debt. This was the first big one. Then later on, this program was enriched by the purchase of long-term treasury security. This occurred in March 2009, occurred again in November 2010, and then in January 2013 as an addition to the program implemented in September 2012 of new purchases of agency MBS. Now, what is the effect of this large-scale asset purchases? Well, if you remember the balance sheet that you saw, when you buy long-term securities and you buy other assets, the asset side increases. So the size, since the liability have to follow to balance it, the size of the balance sheet increases. And another program that has been implemented is the maturity extension program. This is a program that also affects the balance sheet, but it affects it in a different way because the program is the purchase of long-term treasury security and the sale of short-term treasury security. So what happens is that the total holding of treasury security doesn't change, but the maturity composition changes. Okay? This also has a stimulative effect. And again, you will hear a lot about the transmission mechanism of these purchases to the economy. And this is also an effect because it removes duration from the markets. So the asset holding progressively since 2008 have become an important element of how the Fed conducts policy. And so you would wonder, is that a good way of conducting policy? Is this a new operating target with the features that the federal funds rate has? Well, we still are struggling to understand exactly how the balance sheet policy and this LSAP work through the economy. This is just a visual way of telling you that this is just zooming into the more recent period, that even with the interest rate, the federal funds rate at the zero lower bound, the long-term rate have seen some decline, and this vertical line indicates the time of the various LSAP programs, the MEP and the recent LSAP that has been in two parts and is also slightly different, as I will mention later. So what's the impact on the balance sheet? Well, you can focus on the fact that now the security are not just the treasury securities, but are also agency debt and MBS, is essentially MBS here. The total is much bigger, is about 3 trillion of assets, and this has put us on a different situation in terms of how to conduct policy going forward. Visually, this is a picture you might have said, I think is on our website. You can visualize how the assets now, the size, the amount of treasury security that we hold is much bigger than the one that we held before. Is also mostly, has a larger composition of long-term treasuries as opposed to short-term. This light blue is all the other asset, the mortgage-backed security, essentially. And this part here was the part in which the Fed was doing a number of liquidity, open number of liquidity facilities, so was also operating heavily with the balance sheet. As a correspondent to this asset side, we have a liability side, and again, this are now the currency. They see us steadily increasing, but not that much, and this is all new reserves. So that said, let me talk about the structure of the decision making. So I think we got through the tools, the operating targets. Now, who decide the tools? Who decide the operating targets? The Board of Governors is the body of the Federal Reserve. Is composed of the seven governors that are appointed by the U.S. President and has to be confirmed by the Senate. Then the Board of Governors makes the decision about these three tools. That's why I kept the 4 tools separate. So the decision about these 3 is made by the Board of Governors. The FOMC is the very important body that makes the policy decision. The FOMC is composed of the governors plus the president of the Federal Reserve. But then, and this is a body that meets 8 times a year and makes those decisions. The decision of the level of the federal funds rate, the forward guidance on the federal funds rate, the asset purchases that will be implemented, and this decision then get, again, you will hear this later in the communication, get communicated to the public through the statement at the end of the FOMC meeting, and then gets elaborated in the minutes that get released 3 weeks after the meetings, and all the deliberation of the FOMC meetings is made public after 4 years in the transcripts. One important distinction I would like to make is that the FOMC, often you read who votes, who doesn't vote. Not everybody votes. Not all the president votes every time. The only president that votes every time is the president of the New York Fed. The other presidents rotate, while the board members are always voting members of the FOMC. So there are the governors, the president, and 4 other presidents that vote in the decision. And there can be dissenting votes. So there can be some participant, as has been naturally in the past quite often, that if the measures are accommodative, there is someone that dissents and would like to have more tightening. The other important, very important piece of the monetary policy is the New York Fed operating desk. And there are directives that the FOMC gives to the New York operating desk, and the desk implements open market operation in order to reach the operating target. And this is what Chris will talk about. Now, what's a strategy? Rob already mentioned, so I'll go quickly. The last January 2012, the Fed issued a statement on long-run goals and policy strategy. The long-run goals were a way of making a quantitative definition of the goals that are present in the dual mandate. So the inflation at a rate of 2% and maximum employment. The policy strategy. What is the policy that the Fed says? Well, the Fed has to mitigate the deviation of inflation from its longer run goal and employment from the assessment of the maximum level. So this policy strategy is a sort of a flexible inflation targeting. So there is a target on inflation. Now it's quantified after many years of attempt to quantify, is now a 2% number. And, but there is the concern about the real economy. So it's a flexible. It's not just a tight inflation targeting. This picture you have seen, so that's what all the members say, how they see the economy in the medium run and how they see it in the longer run. And so when they see that they are not accomplishing the goals here or here, what they do, they have to take some decision. And the decision reflects their assessment of how far with the current policy they will stay from the objectives. And then they have to evaluate the possible trade-offs. You know, if we close too fast, what consequences we are. If we are too slow and don't close the gap, what consequences there are. And once they make this evaluation, when they sit around this table at their FOMC meeting, there's a lot of discussion. There is a round in which they discuss the economy, then the round in which they discuss policy, and they come to a decision that is based on 2 elements: how much they want to signal about the future path of the federal funds rate, given that they, once they say that they stay at the zero lower bound, for how long they think they are going to stay, and how much, if at all, they need to increase the purchases, the program in place, or substitute with another program. So 2 decisions. And then let me go through how the decisions then get communicated to the public. The federal funds rate policy is communicated with this kind of language. This is from the last FOMC statement of January, the January meeting. Soon we will have another one in March. So the Fed says that the highly accommodative stance will remain appropriate for a considerable time after the asset purchase program ends and the economy strengthens. This has been a very strong language because it suggests that the Fed is remaining accommodative and is remaining accommodative until it really sees the economy picking up. We have been out of the recession formally since 2009, but everybody agrees that the economy is moving very slowly. At the beginning of the year, in the past few years, there's been always the sentiment that things were picking up, and then there was a slap in the face, and the economy still remained pretty the recovery remained pretty weak. So now this strong language suggests that the Fed is completely beyond the accommodation program. And also, as Rob mentioned, the Fed introduces the threshold. So what's the meaning of the threshold? What's the meaning of this additional guidepost? And what's their relation with the long-term rate? So the Fed has been following, and Krishna will elaborate on that in his discussion of communication. The Fed need to convince people that it's accommodative. So at the beginning, try to convince people by saying, look, we are not going to be exiting the zero lower bound for some times. We are not going to exit for an extended period of time. We are not going to exit till 2014. We are not 13. Then we are not going to exit till 2014. But now it's hard to move this guidepost all the time, and so the Fed adopted what we call a state contingent forward guidance. So it says that it will remain accommodative until it sees some concrete improvement. And so it has quantified the concrete improvement in terms of which kind of unemployment rate I would like to see before I even think of moving. So it's a threshold, not a trigger. And so it's set to 6.5%. So it's a little higher than what his eventual long-run goal is, but is a guidepost. At the same time, what may happen? Well, suppose the economy starts to really get steam, okay, and inflation starts to pick up. Well, then you have to be considering that you don't want inflation to go too far high and inflation expectation to go too far high. So there is another threshold that is put in place. Okay? What about the asset purchases? What about the policy that the FOMC has announced in the last meeting? Well, this policy is based on a new program of MBS purchases that was put in place in September, and is a program that is different from the way the first program and the second program were announced, in which the Fed was setting a stock of purchases and continue till the stock of purchases were completed. Now there is a flow of purchase that is announced. What's the rationale for this? It partly is that the Fed is not pre-committing to a stock of purchases. It's pre-committing to an accommodative stance. Again, that will be adjusted depending on which results you achieve. And so if you read the part that I call forward guidance, it said that the committee will continue its purchases of treasuries and agency mortgage-backed security until the improvement in the labor market in a context of price stability is achieved. So also the purchases have in mind, as a goal, the one of achieving some concrete results in terms of employment that are not as tightly specified as for the Fed funds rate, but are still communicated as an important goals of the asset purchase program. Why they are not specified as precisely as the zero lower bound? Well, because the committee, as I said, this is a new tool. It's a tool of which we don't have complete knowledge of how it operates, and so the committee will have to take into account every time, over time, of the efficacy and cost of the purchases. So it has to make sure that the efficacies outweigh the cost in order to continue the program with the intention of maintaining running until the employment objective is reached. What are the challenges? I'm closing with these challenges ahead. As usual, we have to evaluate when, as usual means even in other normal circumstances with normal policy, there is always the difficult decision of when is the time to move from a accommodative stance to a more neutral stance and then to a tightening stance. And so in this case, what's the appropriate time in which we have to lift off the interest rate from the zero lower bound? In addition, the question is what will be the appropriate stance of the appropriate pace of increase. So some of you before asked a question about the Taylor rule, which kind of policy reaction function we will follow to determine how much the interest rate should respond to the evolution of the economy. So how fast we are going to raise and what will guide our action. That's about the federal funds problems decision. Then there are decisions about the asset purchases. The asset purchase decisions are much more complicated because they carry with them more baggage. So it's important to evaluate the efficacy and cost of these purchases. How much are they, how effective they are. I gave you some intuitive sense that the long-term rates are indeed following. But can we measure this exactly? There are lots of event studies that measure how the large-scale asset purchases have affected the economy, and certainly the judge is still there. And then how we will address the risks, how the risk inherent in a high balance sheet can be mitigated, and which kind of risk. You probably constantly hear or read op-eds that discuss how risky is the policies of the asset purchases. So what does this imply when the interest rates are going to go up? Because at some point we all hope that we are not stuck in a Japan situation for 20 years. So at some point the interest rate will go up. And what will happen to the capital losses that we may encounter on our asset? What will happen on the flow of income that we transfer to the Treasury? Then there are risks of the operational risk of managing the high balance sheet. This is a new situation, and we have a desk that is extremely expert in that, but there are risks in this operation. And then the exit. When we renormalize the economy, at some point we will be happy and see that the economy is getting speed. We have to decide the federal funds rate, and we have to decide how to renormalize this balance sheet. As you saw, we moved from below 1 trillion to more than 3 trillion. What's the right size of the balance sheet, and how we will converge to this right size? These are the problems that we face now. There were in June 2011 and one other point in which the economy seemed to actually start to pick up. Then the FOMC put some guidelines on how we will exit from the extreme accommodation. Now, the balance sheet now is much different from what it was in 2011, and so there is a discussion of reconsidering these principles. You know, how fast you want to sell the asset, should you sell the asset at all, should just let them wane down. All these problems are the problems that now are very important in not only in deciding, because they affect how we exit, but insofar as we continue the accommodation, the continuation of the accommodation has to have clear in mind how you can reverse this when the time will come, which is not yet there. Okay, I think this is the end. Yes.
Thank you. Thank you.